Welcome friends, welcome to this edition of BCAS Tax Gurucool. In this edition, we are going to discuss TDS at higher rates on the non-filers. The TDS landscape has been changing over the past several years. If we look at the Section 4 of the Income Tax Act, TDS is mentioned as one of the ways in which taxes will be collected by the government. However, we have seen that next we have seen that the TDS regime has been expanded not just for collection of taxes but for several reasons. For example, TDS on salaries is introduced so that the employee is not required to pay the tax at the end of the year or calculate advance tax and pay it each quarter, which might be difficult for each employee. TDS is also required for reporting of certain high value transactions, for capturing certain dividend payments, and also certain consumer to business transactions like payment of rent by individuals and payments to contractors, etc. Personal payments also now are covered under TDS, like payment to self by way of a transfer to your own overseas account under the liberalized remittance scheme, or even withdrawal of cash and certain types of e-commerce transactions which may not actually result in any income, but still they are now liable to TDS. Effectively, if one was to summarize, the motive is not just to collect tax, which was the original intention of Section 4, but the motive now is to catch those who are not paying taxes or not filing returns. And the idea seems to be to throw the net as wide as possible so that no one can escape. This is perhaps understandable considering that a very small percentage of Indian residents are actually filing income tax returns, and this is a very good way of capturing such non-filers. Now, this TDS requirement brings into effect certain obligations on the deductor, and he has to deduct the tax monthly, he has to file the returns quarterly, issue TDS certificates quarterly. There are technical challenges which one faces because he has to update his tax system, the accounting system, or the ERP or SAP, whichever he is following, to capture the right transactions at the right rate, because the consequences of non-deduction are quite serious. We had section 206C1H, which was in respect of TDS on certain types of sales. Now we have got TDS under section 194Q in respect of certain types of purchases, and there is a lot of debate going on as to which will prevail over the other, and how does the deductor or collector come to know in which category he falls. In this backdrop, we have now this section 206AB, which brings into effect TDS at higher rates for non-filers. The larger question one may ask at this stage is there any ease of doing business? Is the deductor an agent of the government or an unpaid quasi-government authority himself? There will be certainly increased cost of compliance because there will be system upgradation required, and audit and scrutiny of the same transaction by different regulatory authorities relying upon the information received, which will make uh, the deductee as well as deductor's life quite miserable, in the sense that they will need to comply with each and every query which comes from various departments. With this backdrop, let us discuss some more detail the TDS on non-filers under section 206AB for TDS and 206CAA for TCS. This has been brought into effect from 1st July 2021 as a result of the enactment of the sections by the Finance Act 2021. And while the Finance Bill 2021 was introduced, the rationale was given in the explanatory memorandum, and I will read from that. Section 206AA provides for higher TDS rates for non-furnishing of PAN. Similarly, 206CC provides for higher rate of TCS for non-furnishing of PAN. It is seen that while these provisions have served their purpose in ensuring that SSEs obtain and furnish their PAN by various persons, there is a need to have similar provisions to ensure that filing of return of income by those persons who have suffered a reasonable amount of tax by way of TDS or TCS. In this backdrop, we have got section 206AB, where it is specified that the rate of TDS for these specified persons is twice the rate specified in the relevant section, or twice the rates in force, or at the rate of 5%, whichever is highest. And if there is no PAN and 206AA applies, tax will be deducted at higher of either 206AA or 206AB, higher of both the sections. Effectively, what happens is that the cost of non-compliance or not filing of returns is going to increase. If somebody is filing all his tax returns from time to time, the TDS is low and he can hang around freely. If he has got a PAN but he is not filing the returns, the rate of TDS will be higher. And if he is not having PAN and he is not filing returns, obviously the rate of TDS will be the highest. So the cost of non-compliance is going to be more. So if we are to compare section 206AA, which deals with no PAN cases, and 206AB, which deals with the non-filers. If a PAN is not furnished, section 206AA will apply. If the return is not filed for the last 2 years, section 206AB will apply. And if the PAN is not furnished and the return is not filed for the last 2 years, then higher of both the rates will apply. Now, to whom this section 206AB applies? We have discussed that it applies to specified persons. Who is such a specified person? Such a person is one who has not filed his return of income for both the two assessment years relevant to the two previous years immediately prior to the previous year in which the tax is required to be deducted at the time of for which the time of filing of the return of income has expired, and the total amount of TDS in his case, TDS plus TCS in his case, exceeds rupees 50,000. A non-resident who does not have a permanent establishment is excluded from this section, from the rigors of this section. There are certain sections which are excluded, and these will need not be filtered under section 206AB. These are section 192, which deals with TDS on salaries, 192A, which deals with payments of accumulated income due to an employee, 194B, which deals with winnings from lotteries, 194BB, winnings from horse races, 194 LBC in respect of investment in securitization trust, and 194A and dealing with cash withdrawal. While 206AB will not apply, section 206AA will definitely apply to these above sections, and if the PAN is not there, the consequences of 206AA will definitely apply. If you was to analyze the impact of the section 206AB, The section applies to persons who have got a TDS plus TCS of more than 50,000 in both the earlier years. Normally, when we look at the threshold for TDS or TCS, the threshold is fixed with reference to the amount of income or the amount of payment. But here it is not with reference to the amount of income or the amount of payment, but it is with reference to the amount of TDS and TCS. And the language of the section gives some doubt as to whether the TDS plus TCS should exceed rupees 50,000 in his case, whether that implies in the case of the deductor or the deductee. But and both the views are possible, but the better view seems to be that it is the threshold limit of the 50,000 in respect of the deductee from all the different deductors. So if a particular deductor is doing TDS of lower than 50,000, even then section 206 AB will apply. Now these are the various conditions which need to be checked at the time of payment of the TDS, at the time of payment or credit, whichever is earlier, to the respective vendor. The question arises whether this testing has to be done each time or once in the year. The language of the section somehow gives an impression that this has to be done at the time of each payment and whether a particular due date has elapsed. For example, if the due date of filing the return is 31st July and somebody is making the payment in the month of August, but whether one has to see whether the return for the last 2 years which were due up to 31st July have been filed or not. Luckily, the CBDT has in its circular came out that no, this does not have to be done on a very real-time basis. One has to do this testing once in a year at the time of the beginning of the year or for the current year from 1st July 21. And if somebody is not a specified person on that date, the full year, the TDS will not be applicable. At the same time, if somebody who was not eligible, not a specified person at the beginning of the year, subsequently he has filed his returns for the pending years, he will have to go to the deductor and provide the details of such filing, and the deductor will then apply the normal rate of tax, and 206 AB will not apply provided he files the pending returns which were due but not filed earlier. In order to help the taxpayers on identifying such deductees, because the were deductees are not persons who will be able to disclose their income return filing status or who would be wanting to give their return filing status to the deductors. In fact, just before July 21, many corporates sent out formats of declarations to the vendors that you please certify that you have filed your return and that the TDS was above 50,000 or not, and all these details. Some corporates went to the extent of demanding the tax return copies of the deductees. Now, this is certainly violating the personal privacy and confidentiality of the deductees, and the government has come out with a Section 206AB compliance utility, which is available at the reporting portal, which is https colon slash slash report.insight.gov.in. On that site, one can do the verification of up to 10,000 entries at a time, and step-by-step guidance is provided. This is a very positive step taken by the government, because without this there would have been lot of disputes between the deductors and deductees as to who is liable to TDS at the higher rate and who is not, and whether a declaration given by the deductee is good enough, sufficient, and the deductor will be obliged to keep a copy and maintain it for several years before the demand can arise. So this utility is much a step in the right direction. The steps on the reporting portal are quite simple. the reporting portal, one has to log in using the 10 of the deductor. If one is not having a 10, then one has to obtain the 10. If one is having a registration on the Traces portal, one can log in from the Traces portal and from there access the reporting portal. And if he has got a pen or 10, then from each there are four different options under which login is possible, and from each one ultimately he has to log into the trace reporting portal using the 10, and the credentials will have to be generated first and then submitted, and once it is submitted, then it becomes a very routine affair. At the time of any new vendor, the deductor can check whether the deductee is compliant or not. There are various steps required for on the reporting portal for registration, and basically these are quite simple steps. One has to generate a one-time password, and the usual steps need to be followed. And once this is very simple step-by-step guidance is available on the reporting portal, I will not go into the details of that, but through experience I can assure you that it is a fairly simple process, and having registered, the getting the output of the deductees is quite simple. So there are several sections which have not been excluded are now covered by section 206AB, namely 193 dealing with interest on securities, 194 dealing with dividend income, 194A dividend interest from banks and others, payments to contractors, insurance commission, payment in respect of life insurance policy under the National Savings Scheme, repurchase of units of mutual funds, commission on sale of lottery tickets, commission and brokerage, rent, transfer of immovable property, payment of rent by individual or HUF, redevelopment of society, fees for technical or professional services, income in respect of units of mutual funds, compensation on certain immovable property, business trust, investment funds, e-commerce operator, TDS on purchase of goods, TCS on specified senior citizens, and so on. So basically, all other sections which are not excluded are covered by the section 206AB. Now briefly we'll touch upon 206 CCA, which is the mirror image of 206AB in respect of TCS. Here also the rate of TCS is higher than the twice the rate mentioned in the relevant section, or 5%, and if PAN is not available, same way both the provisions and higher of the two rates will apply. Let us consider a couple of other examples where this position, these sections will apply, and there could be two views. Suppose a deductee provides a certificate under section 197 of lower TDS, whether a check of utility under section 206AB is required or not. In my view, while applying for a lower deduction certificate under section 197, one is first required to provide copies of the returns for the last 3 years, and a certificate for lower TDS under 197 is issued only if you have filed returns for the last 3 years. Therefore, the question of checking for the last 2 years under 206 AB will not arise, and one can straight away apply the lower rate as mentioned in the 197 certificate. There are certain deductees who are providing declarations in form 15G and 15H. Question will arise whether 15G and 15H are good enough. One view is that if TDS is to be deducted, only then 206AB will apply, And if 206, if the tax is not deducted basis the declaration under 15G or 15H, then the question of verification under 206AB will not arise. But this appears to be a loophole because this will be a window for people to give declarations under Form 15G and 15H, but they have not filed their returns for last more than 2 years. There are certain questions which need to be addressed and one needs to ascertain what will be the position in such cases. For example, payment is made to a new company which has not filed returns obviously for the earlier 2 years. We have done a physical checking in respect of such a new company and we have found that the utility does not identify such cases as specified persons, and therefore this is some good news that the utility recognizes that if the company was not in existence, the question of filing its returns for the earlier 2 years does not arise. But minor becoming major, a minor may have obtained a PAN card, but he might have some nominal income which would be clubbed in the income of his parents. In such a case, if the minor becomes major and gets income in his own name in respect of, say, let us say, interest, whether 206AB will apply or not. Technically, he was not required to file his return for the earlier 2 years, but one will need to see whether the utility identifies such a case or not. And basically, utility is not as such binding on the taxpayer. Even if the utility says that the payee is a specified person, if the deductor can identify that on facts this person was not liable to file his returns earlier, he can take a view and apply the TDS at the normal rates. Similar question will be for a non-resident Indian who was outside India but had a PAN, was not filing returns earlier. What will happen to his case? That again one will have to take a practical view. A retired person who was not filing returns but suddenly gets some income from some source, and whether he will be treated as a defaulter or a specified person for the purpose of 206AB, that will depend on the view which will have to be taken as to whether he was required to file the return or not. Another question is payment of rent to a non-resident. We saw that the section excludes non-residents who are not having a permanent establishment in India. If there is a permanent establishment, because when you are getting rent, it means you are having a fixed place in India and you are earning income from that. So perhaps 206AB will apply unless he has not filed the returns for the last 2 years. With this, I thank you for a patient listening and will welcome questions at the email address provided, and have a good day. Thank you.